Good afternoon. Thank you all for joining this webinar series hosted by Steve Napolitano and AmTrust Title. My name is Steve Jason. I'm the managing principal of EOS Real Estate and Financial Advisory. We're a boutique real estate services firm focused on asset management and transaction management for owners and debt and equity providers, as well as company operating efficiencies. I'm pleased to be invited by AmTrust to moderate and participate in this panel today. The topic, as you all know, is originations, modifications, and forbearance and perspectives from a wonderful set of expert panelists who are on the front line. Just to start with a quick overview. We all know it's been about 7 months into this horrible pandemic. We went from an environment of robust originations and transactional activity across all asset classes to a transitional period, which we're now in, of modification and forbearance with far decreased originations. While we're beginning to see some pickup in activity as the economy slowly recovers, the recovery, as we know, is uneven, sluggish at best, and unfortunately in some areas, just quite frankly, losing momentum. So we're kind of stuck in this transitional period. Maybe can be characterized as first the shock of the event and the pandemic itself. There's always a little bit of denial that accompanies that. We've got to process and move through, get some acceptance, at some point capitulation and the ability to move forward. But when and what's next? In today's panel discussion, we'll be discussing with the experts on the front line what's been going on for the last 7 months, at least what they've been doing, and what could be next. If you have any questions, by the way, we'll be discussing with our experts. Please submit an email to Anuska at AmTrust, and the panelists can reply to you after the webinar is over. Each panelist brings a different perspective to the issue as they represent different parts of the industry. We have the asset management side of the originations platform, legal, and servicing. So again, in advance, I want to thank our panelists, who I truly appreciate their participation. And now I'm going to have them introduce themselves. Lee, why don't we start with you, please?
Sure. Hi, everybody. It's a pleasure to be here on this crazy day. I am a managing director at Basis Investment Group. Basis is a diversified commercial real estate investment platform. We were founded in 2009 by Tammy K. Jones to invest across the capital spectrum, mostly in the middle market. We do transactions throughout the U.S. We're headquartered in New York, and we're one of the only minority and women-owned firms in the space, which I think gives us a little bit of a unique perspective.
Bill?
Good afternoon. I'm Bill O'Connor. I'm with the law firm of Thompson & Knight. I'm the office leader in our New York office and co-chair of our real estate capital markets practice group, which is multidimensional. And my specialty for a while has been in the distressed debt area, which is what we're talking about today. So pleasure to be here, Steve. Thanks for inviting me.
You bet. Tim?
Hi, everyone. Hope everyone is doing well today. My name is Tim Mazzetti. I head up the loan servicing, asset management, and special servicing commercial real estate business in the United States for a company called Citus AMC. It was actually formed as a joint venture between Citus, which is the commercial real estate aspect of the business, and a company called AMC, which does mostly the residential side of the business. So in combination, we're about 3,300 people around the globe, 25 offices in the United States, and 6 offices in Europe and India. And we specialize in providing what I call the life of loan services for commercial real estate and residential. And that includes everything from contract underwriting, due diligence, valuation services, servicing, asset management, special servicing, and also staffing solutions. So it's an interesting company, and it's been a really interesting year, as we're going to talk about right now.
Thanks, Tim. So I wanted to just take the quick survey. I think we all know the answer, but the last 7 months, I want to know just quick one word been playing primarily offense or primarily defense? Tim?
A lot of defense, but you know, the first 6 months of this year was just trying to get a handle on what was going on, and I think that kind of summarizes what most of us were doing.
Right. Bill?
Yeah, I'd agree. Defense, a lot, trying to find the ball on the ground with everybody jumping at it. It's been been chaotic. It's been chaotic.
Yeah. Lee, I left you last because I know you're a little bit of a mix, but
Yeah, well, Basis is still originating. Our volume's a little bit down, of course, but we've been originating. We've done about 350 year to date. We're probably a little more in the multifamily side right now, just as a defensive mood. I am head of asset management, so my day is spent playing defense for the most part.
right. That's what I kind of figured. Look, I know right now, given what we do as well and working with clients, it's primarily defense. And at this point in talking about or figuring out what levers to pull, how to work things through, it's not only about the asset type, but is importantly about the capital, what will be needed, the timing to deploy that capital, because at the end of the day, what is it we're going to do with this asset? And understanding in this crazy environment, as I said, I think before, with the market down 800 points today, oh my goodness, what should we be doing? And what levers should we be pulling? And look, when you're looking at modifications and forbearance and working with the borrower, there are many types of relief: interest forbearance, forgiveness. You can use reserves, guarantees, AB notes, whatever. And of course, in some cases, you already have to start exercising remedies regardless of what's going on. So Bill, why don't you kick off kind of what you've been doing in terms of these forbearance modifications and some cases remedies? You kind of touch all sides. You represent borrowers and lenders. So without giving you any trade secrets, tell us a little bit what you've been doing. Sounds like you've been busy.
We do represent a few borrowers. Most of our practice group is on the real estate finance side with lenders and special servicers. And but what we've been seeing on both sides is, first of all, I think I said when we were getting ready for the panel that we've been drinking from the fire hose with respect to the volume of deals that require attention that are coming over the transom to specials or going into the classified assets and special asset departments of the banks and to the funds, et cetera. And there've been varying types of transactions in the first 2 quarters, the vast majority of which in the beginning were the simple modifications, the simple forbearance, to coin something my friend Tim says, kick the can down the road so we can figure out what's going on. And so there's been a lot of that. And also in the midst of this, we've had, a number of actions taken by the states, as we all know, because we watch too much TV. Most of the response was delegated to the states to handle, and in this case, real estate's local anyway. So, but we've had a number of executive orders and similar court rules and court regs and court pronouncements that have tied up any kind of remedies that you might want to have in most states, and moratoriums and kicking statute of limitations out and preventing evictions, preventing foreclosures on the real estate, both commercial and residential. And this creates a lot of stress, of course, in the sector. And it's not, it's like dominoes. The tenant can't pay, so the landlord can't pay, which is a sponsor who can't pay the servicer, who can't pay, so it doesn't get to the bondholders and the CMBS. So it's been something to see. And there are a couple of remedies that have come out with that. We have had a significant amount of success with UCC 9 foreclosures in order to move the ball forward with what I call bad borrowers. And those are borrowers that were teetering on the edge or not performing well before COVID. Of course, every borrower who's in default now says that COVID affects them. Well, yeah, it affects everybody, but it's not the reason you are delinquent or in default on your loan, So UCC 9 foreclosures, which are like mezzanine foreclosures, or where you have dual collateral, where the membership interest, the ownership interest has been pledged as well. you have the rights under UCC 9 to start a foreclosure action, and they're very litigious, so they're not. People shouldn't think they're a quick remedy. There's a lot of injunction practice and all that which goes on. Recently, we've won some cases where the courts have determined that these are not foreclosures as defined under state law. The other thing that's been interesting is to see is the use of receiverships on their lonesome, either in state or federal court, to get control of the cash flows of properties and bring the borrower to the table to discuss. And those are the two things that are going on a lot now. We're coming to a period where, okay, our forbearance, our mods are burning off, the PPP money is being paid off, and now I think Lee was talking about this earlier before the call. We've got borrowers coming up and saying, I need fill in the blank, and it's usually more than a year to deal with this. And so that's where we are right now, and that's the big challenge.
Yeah, I mean, Tim, I want you to speak to this because I know you're doing, the borrowers are pitching, guys doing a lot of catching. But one thing before we move to Tim, Bill, how has it been? And then I'd like to hear from Tim, moving ahead with these remedies for lenders. Have you been able to? Is stuff clogged up in the courts? What's going on? Is there any to this?
It's a function of what we have a national practice. It's a function of what state you're in. Florida has really gotten out in front of the digital side of it, and we've had some cases down there where one in Fort Lauderdale recently with some hospitality units where we're able to move quickly. The courts are digital, they're virtual. California's had that for decades. New York is now really getting it together, and we've had some recent successes with the virtual aspect of it. So getting the courts to consider and approach it, they're dealing with it now, and it's not like it was in the beginning where somebody blew the whistle, we all had to get out of the pool, so the courts were empty. But now it is, and this may be a long-term silver lining of the pandemic, that there'll be more virtual arguments, conferences, mediations, and a lot more pressure than there were in the past. No more standing around in the hallway.
So we do have one positive good thing. I like that.
Well, yeah, that's one. Yeah.
Yeah. Tim, what about you? What are forbearance modifications, the activity, pace of defaults versus transfers? Give us a lens into that.
Yeah, I'll share anecdotally what's been going on in our shop is probably a good insight into many of the other special servicers in the industry. And as Bill pointed out, I hate using baseball analogies, but since we just finished the World Series, congratulations, Dodgers. We're probably in the second inning of this process. And if I can use that same baseball analogy, the first inning was literally trying to just find home base.
Right.
We literally, going back to what Bill said, we have never in our lives experienced a 100-0 complete shutdown of entire economies. And it was interesting, just using my own platform as an example. Once we figured out that this was going to have huge negative ramifications for income producing real estate, primarily hospitality and retail, and we'll talk about the other classes that are going to be impacted by this longer term, like apartments and office. We try to figure out, okay, we got to get ready for this because it could be a tsunami. What ended up happening, and I think it's a kudos to the master servicers, the special servicers, the legal counsel, CREFC, the MBA, hats off to them, and saying, look, this is no one's fault. It wasn't like 2008, where there was a lot of bad boy acts going on. People knew they were over levered. People knew they were doing some bad stuff. And it was just, we need to wipe out the system and reset. This was no one's fault. People had restaurants and hotels and retail centers just by fiat shut down. And so where we took the approach initially and said, oh my God, we have to get ready for this tsunami of defaulted loans, it actually transferred. The vast majority of our activity was restructuring. And most of you who know in the CMBS world, once a loan gets transferred to special, fees get kicked up. I will tell you that we forgave a lot of fees and we gave up a lot of workout fees. We had assets literally transfer into special servicing, And that once we figured out and we had a conversation and a dialogue going on with the borrower, hey, let's restructure this. Let's not create a complete default. Let's give you 3 to 6 months. Give us some extra capital. Let's not just steal from the FF&E reserves and what have you, because I don't want to end up 6 months from now, as may be the case, because as Bill said, some of these are now coming back for round 2, because the first 3 or 6 months are not going to be enough to get them over to the finish line. I don't want to end up with 0 reserves and all my collateral gone, and now I've got nothing, especially in a heavily operating environment. So in most cases, our restructures were pretty serious. We got them to put in some additional capital, some additional equity, some personal guarantees. Let's leverage some of your reserves. Let's give up some of your DSCR and other covenants and give you time, give you 3 months, give you 6 months, but not just for you, for us, for the rest of the industry. My crystal ball, I've been joking, is cracked and cloudy. I'll be honest with you, here we are 7 months later, it's still cracked and cloudy.
Yep.
Because until we get a vaccine, until we have a better line of sight to actually coming back out and having some resemblance of normalcy, I can't tell you. Go to what Lee said. Borrowers are coming to me in a hotel and saying, yeah, my 3 or 6 months forbearance ain't going to cut it. We already have several. They're not even up to the end of their initial forbearance. They've already thrown their hat in the ring and said, guys, ain't going to happen. Let's start talking about a longer term.
Right.
And so, you know, if you use that baseball analysis of first or second inning, I think 2021 is going to be very, very active for the 3 of them.
Very well, good. Lee, you're the only true originator on this panel. So tell us what it looked like. You're dealing with the assets and you're the originator and you're dealing with the portfolio.
I think we lost
Yeah,
it.
You're on mute.
Is that better?
absolutely.
Okay.
Absolutely.
I didn't want to hear all the background sirens. I'm in New York City and they're picking up again.
I thought it was going to be your yelling borrowers.
Yeah. Yeah, no, it's been an interesting few months, I have to say. Well, we have basically 2 platforms. We have a closed-end fund, commingled, and then we have agency platforms, so mainly with Freddie Mac. So we have 2 separate sort of functions going on here. On the fund side, we have about 25 direct investments, and we also own B pieces in a couple of deals, both on the fixed and floating rate side. On the direct side, we came out with a program in the first few weeks of COVID, which we called Big Equity, Basis Investment Group Big Equity, or Big Rescue, in which we reached out immediately to all of our borrowers, asked them if they thought that, you know, what their crystal ball was saying. Of course, none of us knew this was going to last as long as it has.
Hopefully not like Tim's, right?
Yeah. And so some of them took us up on the offer to put a little bit more debt on in the form of mezz, in order to either keep their senior loans current or to, you know, make sure that they had a reserve to pay debt service on our loans. Only a small percentage of our borrowers actually did that, which was to us a good sign. And for the most part, they're all current. We have one loan that we're worried about and we're working on the direct side. Now on the BP side, of course, that's a different story. We have, you know, we are the first loss piece. So any losses are going to flow and hit us first. So we have a big interest in making sure that we are in direct communication with either the master servicer or the special servicer. So we have calls on a weekly basis with all the special servicers. We go through all the loans. We've modeled all kinds of different scenarios. We've looked at the impact on our return projections. We have to give consent as the controlling class holder to any major modifications, actually minor ones as well, but in this case they're major. So we get pretty involved. We've assigned specific people on our team to specific assets so that they can follow along and understand exactly what's going on at the asset to the extent that we can, what's going on in the market. But all of this it's going to sound cliche, but it's really all about communication. And there are some sponsors that are better at communicating than others, as we all know. And so it really comes down to getting in touch with the servicers early, working through the issues, relationships. And so basically, it's out right now in terms of what's going to happen. I mean, we've put a lot of loan mods into place on the BP side. Some of them are now coming up for renewal. So I like your analogy as inning 2, although it makes me really tired to think that we have at least 7 more innings to go of this. But that's basically what we've been doing. We are, as Tim said, because we're working through the special servicers. So we're looking at, 3 to 6 months forbearance, using reserves in some cases to bring debt service up to par with current. We've got a few loans that have been hit by tornadoes and hurricanes. So we're looking at insurance issues. I would say for the most part, the loans are distressed due to COVID, but we do have a few that we're having trouble to begin with. We're just sort of limping along. And now we're trying to figure out, how much of this is really due to COVID and how much of this would have happened anyway. And does that affect our strategy, our workout strategy?
Right. I mean, Lee, what I'm hearing you say also, and look, we've all been playing a lot of defense for the last 7 months, and Tim, you alluded to it, and Lee said it, and Bill, I mean, all entered into these modifications, 3, 6 months and so on, because the idea things were supposed to be better. But I'm starting to get questions now too from clients, from others, because borrowers are coming back for round 2. The time has run out, and here we are, round 2 of modifications, and the rubber begins to hit the road. The reserves you used before, now you run into liquidity questions. I mean, Tim, are you starting to see these come back now as well?
Yeah, we've already had 2, as I mentioned. They've actually reached out and they're not even to the end of their initial forbearance term, and they've already said, and they're hotels. We're involved in some very, very, difficult and probably going to drag on for a long time bankruptcies where major urban center, high density hotel has been shut down and there's no likelihood of reopening. I mean, the earliest, the most optimistic estimates that we've heard for maybe business travel and events to start coming back is end of next year, even with a vaccine coming out, let's say in Q1. And when you look at some of the appraisals that are coming in, some of the appraisals on hotels are basically, looking at a full recovery for an urban center, downtown event hotel. They may not recover till pre-COVID numbers until 24, even 2025.
Yeah. So they're at the second. I'm sorry. Go ahead.
Yeah. So very, very, very deep discounts. And again, I'm going to go back to not really having a good crystal ball, but it's such a dysfunctional environment, Steve. I'll give you pros and cons. On the pro side, the estimate I've heard is $1 trillion of fresh capital has been raised, committed, and obviously this is with leverage, sitting on the sidelines looking to invest in distress, whether it's rescue capital, whether it's buying distress, where it's buying non-performing notes, whatever the case is. And in some cases, that's actually given you signs that people are willing to spend capital, and actually the term I use is maybe the first loss may be our best loss, which is not typically how I look at the workout side of the business, especially in a country like the United States, which has formidable capacity to recover. Very often, if you have a good borrower and a good manager of a property who can add some value, I want to keep that guy around, or that lady around, or that person around, or that company around. Keep managing the asset, keep investing in it, and let's wait till we recover, create an A-B structure, whatever the case is. I can give you dozens of examples of high success stories from the 2008 where we did not foreclose. We did not do a quick loan sale at a discount. We did an AB structure, it recovered, and we recovered 100 cents on the dollar for the trust. I'm telling you, there's going to be situations here where we may consider first loss as the best loss. And so it's very interesting. It's a fascinating, from a pure academic standpoint, it's a fascinating environment that we're all trying to figure out how best to handle.
And Tim, I'm going to build on that as a way to kind of transition to one of the other topics we talked about. Look, there's an incredible amount of uncertainty out there. And I think as we talked about before this panel, there's a myriad of factors, all of which are just out there waiting to be resolved. And our federal regulations continue to be eased. So you can do restructurings, don't have to reserve against capital. There's no pressure to move loans from anyone. What's owner borrower liquidity look like? Is more conservative underwriting? Lee, I know LTC, LTV are being pulled in. Lifestyle changes, we could go on for hours talking about the lifestyle changes. There's now surges in subleasing activity, signaling changing an office. But I know the one thing, and Tim, you touched on it, that we talked about and wanted to highlight is we know that with the decrease in lending activity, I think I read something Rionomy said that lending activity was down some 40% over last year. The lack of transaction, the price discovery, and valuations are just such a wild card that impacts everything. And we know, excuse me, the public markets are already begun to react. The REITs have seen their values decrease tremendously. And hey, guess what? A lot of their assets are in CMBS pools, are, income mortgages and so on and so forth. So wait a second, where's that decrease in value there? Hasn't happened yet. And then ultimately, we'll have to get the appraisals. And whether you're a public entity or you're a private fund and you may have to do some type of mark for your investors, but then the valuations, who knows, and they're wild. I just saw about 2 weeks ago a major, for those that know metropolitan New York City area in New Jersey, it's called the HQ Plaza in Morristown. It got an appraisal, it came in 30% decrease, quadruple whammy there. Office, AMC, movie theater, shouldn't laugh, health club, and a Hyatt Regency. I mean, very,
Trifecta.
Or in this case, 4, absolutely. But, Tim or Bill, I mean, what have you seen? Because we do need valuations. This is what's holding it up, and there's so much uncertainty out there. Or anyone jump in. I mean, how difficult is it even getting the appraisal?
Value drives everything in real estate. Drives everything in real estate from the beginning. The sponsor first comes to the first loan, through restructuring, all the way through bankruptcy and liquidation. And if you can't get a handle on valuation, it's a real problem. And one of the things that we have a problem getting is attention from appraisers, right? The appraisers are swamped, as well. There aren't enough appraisers to go around. In the CMBS world, we're fighting off appraisal reduction, right, requirements under the loan docs, because we don't want to do it. It hurts the trust, it hurts the borrower, it hurts everybody. It makes no sense. And I used to joke all the time about stabilized reductions. It's like, okay, we're building a condo on the moon. What'll it look like stabilized? And I can get an appraisal for that. Right. But what in the appraiser's defense, where are the comparables? Where are they can't use the 3 traditional methods of appraisal. So it's very, very difficult. We talked a little bit in preparing for this about BOVs, right? Because some servicers have said, hey, can I swap in a BOV, which means you call up somebody at a national brokerage and say, I need a BOV and I need it to come in at no less than. But I mean, I'm kidding, but BOVs aren't as reliable as appraisals. And I always say appraisals are the alchemist tool of real estate. So we're really
give me the for value,
Right.
Yeah.
And that's it. So I mean, with that, it's not even like an 08 where we're waiting for the falling knife. We don't know where the knife's going, right now.
Right.
Yeah, and again, you have to. There's a huge discrepancy in values as well as in distress in commercial income producing real estate based on geography, type of property, and market, right? So,
Huge.
like I said, you've got a downtown New York heavily unionized market that is, and the unions, as I understand, are making life extremely difficult on the hotel operators in New York. And that's primarily event driven. Well, that is a completely different story than an extended stay on a highway that is now back up to 40, 50, 60% occupancy because of the truck drivers and every first responders and people who have to stay in a hotel, that can reduce their operating costs significantly because they're not turning rooms over daily. They're made services whenever they vacate. They're not offering any of the limited services they had or de minimis. And versus a full service hotel where the food and beverage is getting absolutely killed. No one's going to their hotel to eat, and that was a big piece of their profit. So when you look at these different property types, you have to take that into consideration. And actually, we're seeing some of these extended stay, limited service hotels or destination hotels where people are, going for their staycations because they're not getting on a plane to go to Hawaii or Europe or Caribbean. And they're actually doing okay. They're going to, even in some cases, are starting to turn a profit and even maybe covering some debt service coverage. But to the point, until we have a view of values and can actually have some confidence in them, I think what's going to end up happening is a lot of this real estate, even if it manages to survive through a forbearance or a restructure, is going to eventually come up to a deadline called a maturity date. And we all know a lot of these aren't going to refinance because even though they may cover in the restructure, they're not going to cover because there's going to be an impact in value, right? A 50% occupied extended stay with an ADR that's 20% below pre-COVID is not the same value as the same hotel that it was in February.
Yeah, but
So
Tim,
it's a real challenge.
let me ask you, and then Lee, I want to hear from you, but there's a point where you need an appraisal and you need a value, given what you do. Are you able to get them? Are there battles? Are they pretty straightforward? I mean, what's going on?
Well, I'll give you a worst case scenario on a hotel. Initial appraisal came in at 30 million. DC8 said because they're going to get appraised out, which means they're going to lose control of their bonds. They said, no, we don't agree with that value. They ordered their own appraisal, came in at 75 million. That's a pretty big discrepancy here, more than 2x. And obviously there was no agreement on that one. So they ended up getting a third appraisal, which is kind of, Bill, correct me if I'm wrong, that's kind of the process that's set up in a CMBS trust.
Right.
And the third appraisal, ironically, came in at 55. Ooh, wait a minute. 30,
What were the odds?
75. What are the odds?
The name was Solomon.
Right in the middle. I mean, that's a unique case, right? But it's a true one, and I think that's what we're going to have. And look, it opens up so many issues because from the CMBS side, and now operating advisors have to get involved, right? Which is the kitchen and the chef representing what used to be the DSCH that get appraised out, and all sorts of potential litigation tied to that. And it's just going to complicate our life. And then you've got, Bill on the legal side who is trying to, figure out what to foreclose at, where to set your reserve at. And, and obviously you don't want to overpay and overbid on that, and loan sales and everything else. I'm telling you, some of these loan sales with that $1 trillion worth of capital sitting on there have come in at like 90, 92 cents, 95 cents of the original note amount. And this is a non-performing loan, so they still have to foreclose it. They want to get their hands on the real estate, which Bill and I know could be a very lengthy, difficult process. And yet, if you talk to the investors, they're saying, look, we raised this capital. We learned from 2008. We knew that if we came in early, we're going to get some really good deals. So we got to put that capital to use. But it's not based on any financial analysis that makes any sense today, which is the same issue you have with the appraisers. Because the only methodology of valuation today is the 10-year discounted cash flow.
Right. Or comparable values.
There is no
There aren't any.
And the bid-ask spread right now in the open market is huge, because if you're not a distressed seller, why would you ever sell in the falling knife market? And if you're a buyer with this capital, why are you going to overpay, right? So there's no transactions really taking place that don't have an asterisk.
Right. So
on the
Lee,
legal side, you can't put together a business plan to get to the asset because, it's like we all knew that the states were probably going to extend the moratoriums out past election day. You don't have to be a rocket scientist to figure that one out. But now we don't really know how long it's going to go, you know? So when you, and in judicial states like New York, New Jersey, et cetera, we're years away. We're years away on these assets.
And did you see the Wall Street Journal article earlier this week, headlines? And I think it was like a lot of mainstream media organizations, a little dramatic. But their headline was 40 to 50 million people from San Francisco to New York, i.e. across the country, are either underpaying or delinquent on their apartment rent, and they haven't been evicted because of the moratoriums. So Lee, talk to us. Multi-family. I'm in conversations with Freddie Mac and Fannie Mae. They're both nervous.
Yeah, I agree that valuation is, sorry, go ahead. Okay. No, I agree that valuation is, you know, a huge problem right now. I mean, we are seeing new appraisals come in, and the methodology varies. Even if you do a 10-year DCF, you have to make assumptions, and you have to make assumptions about how long it's going to take to stabilize. Well, how do you do that now? So one appraiser may say, you know, 2 months. One appraiser may say 2 years. So you're going to have a huge variance in your projected cash flow. Some appraisers are putting in like they're just haircutting, you know, by a factor, but some are not. And so there's no consistency right now, and there's no agreement on what to do. I mean, when we first went in, we sort of thought we were going to base it on, you know, the 2019 end of year performance as a benchmark, but you know, that was when we thought this was like a 3-month problem. So it's confusing and it's difficult, and we are getting hit by appraisal reductions, and you know, that hurts us. Yeah, and so we do try to understand at least, you know, the appraiser's assumptions and go through them and make objections where they think that it's reasonable. But yeah, no, it's a problem.
Lee, where I was going with my question to you, Lee, is you mentioned Freddie Mac and you're lending on multifamily.
Mm-hmm.
I'm telling you, multifamily is a real potential issue out there. And I've been in conversations with Fannie and Freddie, and we've got a big Freddie book in our special servicing. I think 11 or 12 deals where we're the named special for 1,200 loans.
Yeah.
I'm starting to see some Freddie deals, you know, which they did their global forbearance program for 3 months. You didn't really have to do much. You got it automatically. Then they had a second 3 months, but you need to get special servicer DCH review and approval, and you need to give us proof that it is being affected by COVID. And now we're starting to see some loans actually tip into special. And I know Fannie's getting really nervous too. So what are you seeing on that side, on the multi side?
Well, we had about, under our program, we had about 10% of our loans go into forbearance. They're all out now except for one. And except for one, they're paying current. There is one though that has moved to special. So, you know, I think that is a trend for sure. And it's too early to tell what's going to happen. Are they going to come out with a new program? Will there be a stimulus package that will help the tenants? Because as you said before, what we're also seeing is, you know, depending on the markets, we have some investments in multifamily in Brooklyn, for example, and on the Upper West Side of Manhattan, where, you know, tenant renewals are like a huge negotiation. These tenants are smart. They know, you know, they know the rules, they know the laws, or if they don't, people tell them what they are, because there's all kinds of groups helping advocate. And, you know, they want a huge drop in rent, or they want 3 months of free rent, or they want an upgrade from a 1-bedroom to a 2-bedroom at the same rent. I mean, all kinds of various things. And landlords are scrambling. They are in a position where they don't have a big choice. They really are trying to retain tenants who are paying, of course. And then you have the opposite problem with the moratoriums on evictions, where they would love to get rid of tenants, but they can't. So it's a problem. And I don't know, here in New York, there's also what I'm worried about long term is just the homeless situation. We're seeing more and more of that here in New York. there are hotels, not just in New York, but in San Francisco and probably other places too, which are contracting with, the city's Department of Homelessness, and they're shifting their hotel usage to homeless shelters. So there's a lot of different problems going on, and I think, it's going to be a while before we can even figure out what's going on.
Yeah, I
We
mean,
were talking about the homeless hotels, and we have a couple in our portfolios that we're working on, and it's great for the special in one aspect, which is you're getting revenue in, and you've got an
Right.
A credit, which is the city, if it's a city of New York or another major city. But the use is really devastating to the property and really difficult, and what you're going to end up with after a period of time is a mess. So it's a really Hobson's choice there. Right now you're getting revenue, but it's not.
Hey, Bill, I've got a question for you. Have you dealt with how the insurance providers are going to look at a hotel that basically changed its use from a hotel to a homeless shelter?
Yeah, they don't like it. They don't like it at all. They don't like. They don't like it at all. That's the answer.
That's a newsflash. There's a. But so let me ask you. I mean,
I had one associate general counsel at a very large insurer say to me, "Tell your servicer to put it on their blanket policy. We don't want to cover this anymore." Like,
Yeah, I
great.
know.
Now I'm going to have a technical failure to pay
if I could, look, we need 5 panels. That's very clear. That goes without saying. So just let me kind of steer a little bit if I could, because Lee, I want to build on something you said. Look, clear as day, we have no price discovery. We've got transaction volume down, so it's very hard to, I would say, stay ahead of that knife, whatever trail it takes, Bill. So we clearly are not exactly sure where we are. I mean, state that. And so it's a question, what would the next 6 months look like? And I think we've all touched upon, depending on the asset class, there's a huge set of factors out there. Whether we get another stimulus package, to your point, Lee, will that help? We'll call it, Class B, C workforce housing, enable them to pay rent or not? When will a vaccine come? If there's not more stimulus, will it create more business layoffs? Sadly, are we really about to surge in the new wave of COVID? Look, fiscal year ending for banks and funds and things may cause things to clean up. I have to say it.
And then throw in climate change.
We have an election in a few days. And then the question is, do we have temporary versus permanent change? I know we have about 5 or 6 minutes left, but Lee, do you ever remember a time with all this uncertainty? We got all these factors out there. I mean, what do you think about what needs to be talked about as we look forward to the next 6 months? What do you think will look about? It's a wide open question, but I'd like to hear from each of you before we wrap this up.
Well, sure. I mean, I've been doing this for a long time, and I think Tim said it earlier. I've never seen anything like this. I mean, right. Just because it happens so fast and so across the board, and it's affected most all sectors. I mean, I think there are some people benefiting from it, but most people are not. Right. So yeah, it's unprecedented, and a pandemic, like, that's science fiction to most of us. So now here we are living through it and trying to figure it out. So I think that there are some real big issues, and I think it's just highlighting the big issues. I mean, we've seen that in terms of the disparity of the pandemic itself, in terms of our healthcare system, in terms of the housing affordability issue. I mean, that's been an issue for a long time, but this is just highlighting that. So climate change. I mean, we have properties that have been clobbered by tornadoes and hurricanes more than ever before, and on top of the pandemic. So there's a lot of stuff that's going on here. On the, maybe on the silver lining side, there have been some innovations in technology that have enabled us all to work very smoothly for the most part from home, those who can, I mean. And so, like what we mentioned earlier in the court system, I mean, I'm kind of hoping that sticks around, that we can do online hearings versus, especially for traffic tickets and things like that. Who wants to sit in court? So it's just I think we'll come back. We always do. We will figure it out. There's going to be some permanent changes. I think the office sector is going to go through some real permanent changes. I think hotel designs are going to be changed permanently. Yeah, I mean, there's a lot of things that are going to change because of this.
Bill?
Some good, some not so good.
Well, we have a lot of experience, Tim and I especially, but not, I think you'd have to go back to the Great Depression, which predates all of us, to see anything that looks anything close to this in terms of just the macroeconomic effect on our country, and hitting across everything, agrarian through industrial, everything, just hitting everything. Like Tim said, 100 to 0 with a blink of an eye, So I don't know. I mean, the only people I see making money right now, there's an article today about, I think it's in the Journal or Forbes about self-storage. They're making a lot of money. Logistical based real estate, industrial and the like are making a lot of money right now. But, the Amazon warehouse, the Walmart warehouses, those things like that. But for the most part, we're all getting hammered. And I think there's a big reset coming. And when we're talking about value, as Tim said, a lot of these loans are 5-year loans. Right, and it's going to take us 2 years before we start digging out. Is what everybody thinks, and we don't have a crystal. We have Tim's crystal ball, which is like crystal ball with cataracts on it. So, so we don't know. But I mean, there's not much time to turn any of these assets around. So I think we're going to have major resets and haircuts, and it's going to be very, very hard. It's going to be very, very hard. And also, I'm comparing it to the Canadian model where they were sending out stimulus checks every month. Right, and their commercial real estate, especially their multis, doing better than ours is. I think we all thought more stimulus checks were on the way, and certainly not one $1,200 check. I mean, the Canadians are paying 2,000 Canadian, so what is that, like $500? No, I'm kidding, but but $2,000 to every resident of Canada monthly. So it's like, that gives you an idea of the scope of what's needed to turn these things around. That's it.
Tim, I mean, the question is, and want to hear from you, is there some trigger event out there? We still TBD. What do you think it's going to look like next 6 months?
Well, I am a naturally optimistic person. So I get up in the morning every day, give bless that I have what I have, and I see the glass half full. So let me leave you with some positives. There is so much stimulus and so much capital and low interest rates long term that are out there, that once we do get a vaccine out and some confidence to come back out, it's going to recover very quickly. The issue that we're dealing with, this particular panel and the business that we happen to be in, I've said this before, the damage is done, okay? Have a lot of cleanup. And to your point, Bill and Lee, we're going to have to reset a number of values. I think there is going to be a reset that needs to be done through a lot of real estate. The good side is, with low interest rates, guess what? When you look at that valuation and that discount rate, you got a lower discount rate, and therefore it's going to mitigate. And that's what we're seeing on some of the more institutional NCRE valuation, the big institutional property valuers. And we have a big piece of our firm does that. We do about $1.5 trillion a year of institutional commercial real estate debt and equity valuation. And we're not seeing that much of a drop off in value yet because it's more institutional, longer term leases, but there will be a reset. And again, it's offset by a lower discount rate, if you will, and cap rates therefore haven't blown out as much. But the damage is done. And obviously hotels and retail, we've been over retailed in this country for decades. I mean, I travel all over Europe and Asia, and we've got way too much retail. That was something that was being disrupted. It's just been accelerated. It's going to reinvent itself. Hotels, we were overbuilt in hotels. New York, a number of markets were already getting soft coming into 2020. That's going to have to be rethought. And there are going to be a number of hotels, as they already have, shut down for good, redeveloped. Same thing with Class B malls, et cetera. Multifamily is going to get hit hard if we don't have some more stimulus. And office, which we really didn't talk about, this work from home environment, this digital advance that you talked about, Lee, is real. It is going to disrupt office. I know. Out of the 25 offices, I have 6 of them in my line of business that I help run. And I got to rethink some of those. And I'm going to tell you right now, it's not to increase my footprint, it's to decrease it. And you're seeing
Right.
that happen already in many markets.
Right, no question, Tim. And again, another panel on the future of office and sublease spiking activity and the hardest occupancy cost. But I guess as the moderator, I get the privilege of going last. So building what you said, trying to be a little optimistic, but understanding that we're in a very difficult time. Clearly, we know there's a lot of capital out there. A lot of equity has been raised. The other good piece of news, but I don't think it'll ultimately change the dynamic, is that the big difference now between where we are, I think we all agree, in the Great Recession, is that banks are better capitalized, funds have a lot of money. That's all good. That means, however, they can hold on a little longer. It doesn't change the dynamic that the reset needs to occur. It just really means that it may take a little time to get there. And so I think that next year, there is that inflection point when banks and or lenders will say, you know what? We're a lender. We're not equity. Maybe we'll give fresh money to the new operator and we'll reset our loan for another 2-3 years out. I do believe that's all coming. That's why we haven't seen short sales or anything like that. I don't think we'll see anything before next year, but I think next year we'll begin to see it because you're correct. The reset structural down has occurred. These things need to be repositioned, and we go through this every once in a while anyway, but the good news is there. So I want to wrap up and close with that if I could. Just want to say thank you to all the panelists, Lee and Bill and Tim. Thanks so much for joining me today. And on behalf of AmTrust Title and me, Steve Jason, and EOS Real Estate and Financial, thank you all for watching, and have a great afternoon. Thanks so much.
Thanks,
Thank you.
Steve. Thanks, Bill and Lee. Have a great day.